Here is the rewritten script. Most people who sell their homes end up writing a check to the IRS for capital gains tax. The overwhelming majority of them never had to. Federal law provides every eligible homeowner with an exclusion that can legally wipe out most or all of that tax obligation. Up to $500,000 for married couples and $250,000 for individuals filing alone. And sitting right on top of that foundation are 3 additional strategies that most older homeowners have simply never encountered. In this video, I'm going to take you through all 4 of them, one by one, in straightforward language anyone can follow. Strategy 1 covers the exclusion itself and explains why even people who try to use it frequently end up with the wrong number. Strategy 2 can shrink your taxable gain before the exclusion ever comes into play. For certain homeowners, it delivers more value than the exclusion itself. Strategy 3 is designed for anyone whose gain pushes past the exclusion ceiling. It keeps your tax rate as low as legally possible on whatever portion you cannot shelter. And strategy 4 is the one almost no one discusses. It does not simply lower your tax bill. It wipes it out completely. Not just for you personally, but for your children and for every person you leave this property to. Make sure you stay through strategy 4. It is the one that silently drains the most money from senior households when they have no idea it even exists. Before we get into strategy 1, I want to tackle 3 assumptions that lead people to believe this video has nothing to offer them. Every single one of those assumptions is incorrect. The first is believing your gains are not large enough to matter. A home purchase for $120,000 back in 1995 is currently valued somewhere between $350,000 and $500,000 in a typical American market. That represents 3 decades of appreciation. Those numbers are not unusual or exceptional. Your gains are almost certainly substantial enough for every strategy covered here to have a meaningful impact on your finances. The second assumption is that your accountant already has this covered. Your tax preparer puts together a return once the sale is finished. They do not sit down with you before the for sale sign goes up and guide you through the math. By the time they lay eyes on the closing documents, every choice that determined your tax liability has already been locked in. The third assumption is that this only applies to high-priced homes in expensive markets. That is simply not accurate. A $300,000 gain on a home in Ohio is treated exactly the same as a $300,000 gain on a home in California. The IRS does not factor in your zip code when calculating what you owe. Now, here is the reason no one involved in your transaction ever sat you down and explained any of this before you sold. Your real estate agent earns somewhere between 5 and 6% of the sale price. Their responsibility ends once the deal closes. The title company is there to process paperwork. The buyer's agent represents the other party, not you. And your tax preparer files documents after everything is already done and settled. Every professional involved in the sale of your home has a clearly defined role for which they are compensated accordingly. Not one of those roles includes sitting across from you before the listing's active and asking whether you have calculated your adjusted basis, whether you understand the 2 out of 5 year requirement, or whether your gain actually exceeds the exclusion threshold. No one in that entire system gets paid to have that conversation, so it simply never happens. Strategy number 1. Here is how the rule works. It is known as the Section 121 exclusion, and it stands as one of the most generous tax benefits in the entire federal tax code. If you have owned your home for at least 2 of the past 5 years, and you have used it as your main residence for at least 2 of the past 5 years, you are eligible to exclude up to $250,000 of capital gain from federal taxation as a single filer, or up to $500,000 if you are married and filing a joint return. That exclusion remains fully intact for 2026. It has not been cut. It has not been altered. It applies to every homeowner who qualifies and files the claim correctly. This rule carries no age restriction whatsoever. You can use it at 45 or at 80. The reason seniors are the group most impacted by this provision is not because of their age, it is because of time. The longer you have held your home, the greater your accumulated gain. A senior who purchased in 1993 and is now selling in 2026 has 33 years of appreciation embedded in that property. That is precisely the range where those $250,000 and $500,000 figures were designed to provide relief. And that is exactly the group that most frequently either does not know the exclusion exists or fails to apply accurately. Strategy number 2. Here is the calculation that trips up most sellers, and it is the one that ultimately determines whether you owe money to the IRS or walk away from the closing table with your full proceeds. Your taxable gain is not simply the difference between what you sold the home for and what you originally paid. That misunderstanding is what costs homeowners tens of thousands of dollars every single year. Your taxable gain is actually the difference between your sale price and something called your adjusted basis. Your adjusted basis is your original purchase price plus every qualifying capital improvement you made throughout your years of ownership, plus the closing costs you paid when you first bought the home. That kitchen renovation you completed in 2008, the new roof installed in 2014, the addition you built in 2017, the HVAC system you replaced in 2021. Each one of those expenditures increases your basis. Every dollar added to your basis reduces your taxable gain by exactly $1. A $40,000 kitchen renovation does not just improve your quality of life while you live there. It permanently removes $40,000 from the portion of your gain that the IRS is allowed to tax. Here is what that looks like in actual numbers. A couple purchased their home in 1994 for $115,000. They are now selling in 2026 for $530,000. The uninformed calculation puts their gain at $415,000, which at the standard 15% long-term capital gains rate means a $62,250 payment to the IRS. Now factor in the improvements they made across 32 years of ownership. A kitchen renovation in 2001 that cost $28,000. A new roof in 2009 for $16,000. A master bathroom addition in 2015 for $52,000. New windows installed throughout the home in 2019 for $14,000. That brings total documented improvements to $110,000. Their adjusted basis becomes $115,000 plus $110,000, equaling $225,000. Their actual gain becomes $530,000 minus $225,000, equaling $305,000. The married couple exclusion of $500,000 covers the entire $305,000 gain. Federal tax owed, $0. The couple that never learned about adjusted basis wrote a check for $62,250. The couple that did the calculation correctly paid absolutely nothing. Same house, same sale price, same year. One calculation made all the difference. This is the moment where some viewers start thinking their situation is different because their gain still pushes past the adjusted figures. If you are filing as a single person with a very large gain, or if you are in a high appreciation market where the numbers climb above $250,000, even after basis adjustments are made, stay with me, because the next strategy was built precisely for your circumstances. Strategy number 3. When your gain exceeds what the exclusion can shelter, there is a legal structure available called an installment sale. Rather than collecting the entire sale price at the closing table, you and the buyer reach an agreement where payment is spread across multiple years. Each year, you report only a portion of the total gain as taxable income. The outcome is that each year's recognized gain may fall within the 0% or 15% capital gains brackets, rather than triggering the 20% rate that kicks in during high-income years. For a single filer sitting on a $400,000 gain after applying the $250,000 exclusion, the difference between taking a full lump sum payment and using a structured installment arrangement can result in more than $15,000 in tax savings. This is a decision that must be negotiated and structured before the closing occurs, not afterward, not at tax filing time, but before you put pen to paper on the sales agreement. Strategy number 4, and this is the one I mentioned at the very beginning. Here is the strategy most people have genuinely never considered, and it is the single most powerful capital gains tool available to any senior homeowner who intends to leave their property to children or grandchildren. It is called the stepped-up basis. When a homeowner dies and passes their home along to an heir, the IRS resets the property's cost basis to its fair market value on the date of the owner's death. Every single dollar of appreciation that built up during the owner's lifetime is permanently erased for capital gains purposes. The heir receives the home with a brand new basis equal to whatever the property is worth on the day they inherit it. If they turn around and sell it the very next week for that same value, their taxable gain is exactly zero. A senior who purchased their home in 1988 for $90,000 and whose home is now worth $480,000 has accumulated $390,000 in appreciation over that time. If that person sells the home outright, even after applying the $250,000 single filer exclusion, they are still left with $140,000 in taxable gain. At 15%, that equals $21,000 owed to the federal government. If that same senior instead passes away and leaves the home to their children, those children inherit the property with a basis of $480,000. They sell it for $480,000. Their taxable gain is zero. The stepped-up basis is confirmed, active federal law as of 2026. According to the Joint Committee on Taxation, it will account for $72.5 billion in foregone federal tax revenue during this year alone. Congress has explored placing restrictions on it at various points. As of right now, it remains fully in effect, and it continues to represent the most valuable estate planning tool available to senior homeowners who have held appreciated real estate for many years. The choice between selling now and leaving the property to heirs is not simply a real estate decision. It is fundamentally a tax decision, and it is one that almost no one makes with complete information, because the real estate agent is not a tax strategist. And the tax strategist is typically not brought into the conversation until after the deed has already changed hands. Before I walk you through the action steps, there is one critically important state-level warning you need to hear. The Section 121 exclusion is a federal provision, and while most states align with it, not every state does. New Jersey does not conform to it. If you are a New Jersey homeowner, you will owe state capital gains tax on your gain, even after the federal exclusion has been applied. California and New York do conform to the federal exclusion, but they tax whatever gain remains at ordinary income rates rather than the lower capital gains rate that applies federally. If you are selling a home in any of those three states, the federal calculation tells only part of the story. A single hour-long conversation with a CPA who is licensed in your state before you list the property can give you a clear picture of exactly what your state will collect and whether the stepped-up basis approach changes the timing of your decision. Here is exactly what you should do before you sell. 4 concrete steps. Step 1. Reconstruct your adjusted basis before you even think about calling a real estate agent. Go back through every significant project you completed on the home since the day you bought it. Pull together receipts, invoices from contractors, permit documentation, and credit card statements from the years those projects were carried out. Your adjusted basis equals your original purchase price, plus all of those documented improvement costs, plus whatever closing cost you paid when you originally bought the home. Every dollar you can document and add to that figure reduces your taxable gain by $1. Step 2. Verify that you meet the 2 out of 5 year test. You must have owned the home for a minimum of 24 months within the last 60 months, and you must have used it as your primary residence for at least 24 of those same 60 months. The 2 periods are not required to overlap with each other, and they do not need to be consecutive. If you temporarily relocated, rented a different residence for a period, or spent time in a care facility, you may still be fully eligible. Confirm your exact dates before concluding that you do not qualify. Step 3. If your fully documented gain after all basis adjustments still surpasses $250,000 as a single filer or $500,000 as a married couple, contact a CPA before accepting any purchase offer. Ask that professional directly about the installment sale structure and whether it makes sense for your particular circumstances. That conversation will cost you a few $100s in professional fees. It could easily save you between $15,000 and $30,000 in taxes. Step 4. If you are not planning to sell in the near term and your home carries significant appreciation, sit down with a CPA or an estate planning attorney and ask whether the stepped-up basis strategy should influence your timeline. For certain senior homeowners, the math reveals that selling now generates a larger tax bill than the cost of simply holding the property for the remainder of their lifetime, and allowing the basis to reset upon transfer. That is a calculation worth putting on paper before any final decision gets made. Here is the complete picture pulled together. Section 121 provides every qualifying homeowner with an exclusion of $250,000 for single filers or $500,000 for married couples on capital gains generated from a home sale. The adjusted basis calculation can drive your gain well below what most people initially assume, and it does this before the exclusion ever comes into play. An installment sale structure can shield gains that exceed the exclusion from being taxed at the highest available rates, and the stepped-up basis eliminates the entirety of a senior homeowner's accumulated gains when the property passes to heirs instead of being sold during the owner's lifetime. None of these are loopholes or grey areas. All of them are codified federal law, and not one of the professionals who walks through your front door during a home sale has any financial reason to explain a single one of them to you before you sign on the dotted line. Share this video with one homeowner you know who is over 65 and considering a sale within the next 2 years. That one share could save them $40,000 or more on a tax bill the IRS will collect without ever once informing them that they were never actually required to pay it. That is exactly what this channel exists to do. I will see you in the next one.